Large cap stocks, mid cap stocks, small cap stocks. Hello and welcome to yet another episode on BSE's Investor Education Awareness Series. I'm Siddharth Zarabi and today I will talk a little more in detail about the large, mid and small cap stocks. You would recall in the previous episode we had looked into the definitions outlined by the SEBI, the new definitions. And just to recap, this is how large cap, mid cap and small cap companies are defined in terms of full market capitalization. Large cap, first to the 100th company. Mid cap, 101 to 250. And small caps, 251st company onwards. Large cap stocks belong to big, well-established organizations. These stocks are regarded as least risky investments, and by investing in large companies, you get excellent long-term stability in returns, provided, and like I said, you invest for a long duration. Some of the good examples of large cap stocks in India include Reliance Industries, TCS, Maruti Suzuki, Infosys, and many others. Now, mid-cap stocks. These are slightly riskier than the large caps and have the potential of giving you better than large cap returns. Now, some names in this category include Biocon, Tata Global Beverages, AIA Engineering, Federal Bank, and this is just a very small picking of such companies. But what you may want to note that unlike large cap companies where a lot of information is publicly available, sometimes it can become difficult for you to judge the stock of a mid cap company if you do not get the right information. So what you need to do is examine the sector well and the company before you invest in mid caps. Mid caps need more hard work basically. These companies are generally startup companies and they are in the development phase. Information on these companies may not be available at all, and this is why this category is considered to be the riskiest. But it can be exciting if you have high risk appetite and a long-term horizon. So if you are interested in investing in small cap stocks, look into basic things such as the short-term and the long-term plans of that company, the revenue model, profitability, external investments, promoter goodwill, and the financial strength of the company to withstand challenging times, among other important parameters. Look into your risk profile and your investment goals before you invest. If you're a new investor, we recommend this very, very highly, that you consult the advice of a financial advisor to help you begin on that specific journey. And with this, we end today's episode and move on to another expert comment. Take a look in.
So what most non-professional investors do, and I would presume that most of you would be coming into the markets for the first time, you kind of allocate your money, and how you invest would be part of it. Now, again, the market cap of the large caps is approximately 80% of the market, and therefore, even if you were to invest on market basis, then 80% of your money would be in large caps. And the easiest way to invest in that is either in a mutual fund of some kind, or in what they call an exchange traded fund, which will match the Sensex perfectly. So that would be one way. The second way is to actually directly invest. So you say, okay, within these large caps, I'm only going to invest in 5 or 10 stocks of the large caps, and then let that be my portfolio. And then for the middle and small caps, it's really a different way of analysis. But the reality is, first of all, we have to do a sift. We have to do a sift saying, does this company have a future? And we have gone through horrible times with COVID-19, and are continuing to do so. And hopefully it will one day be sorted out, but that's still a ways away. And I think that You have to see which companies have got good managements who are able to perform and make money in this kind of environment. And first of all, make a short list of those. Whether there's large cap, medium cap, or small cap is not relevant. The question is, do they have a sustainable and resilient business? And I use the word resilient more. So having said so, whether you allocate, 80-10-10, but the bias should be towards large stocks because those are easily saleable if you need the liquidity. If you're in a small cap and the market turns against you, you're basically going to lose most of your investment. Whereas if you're in a large cap, you should be able to get out if you need the liquidity or if there's any kind of a news that could affect that stock with some loss, but then you'll be able to get out whole. I'll give you an example. For example, if you are investing in alcohol stocks and alcohol is suddenly banned in the whole country, it's not likely, but it is a minute probability simply because we all know that alcohol provides a lot of revenue for states, so it's not likely to go in a hurry. However, we have had states occasionally shut down alcohol Gujarat apart, Bihar stopped alcohol. So that caused a big effect on companies that did a lot of business in Bihar. And that's something that is out of the scene. But you may say, okay, this ban has come, therefore I want to sell my alcohol stock, and you sell it. You'll take a loss because it's after the fact of the news, but at least you'll get most of your money back. So that's why I'm saying it's more comfortable to be the largest proportion of your investments in large caps and some in medium. Small is really, you're betting. There's a lot of khabar going on in the market, which again is not healthy, but it does make markets move occasionally. But in that one, it's like passing the parcel game. If you're left holding the parcel, you're the one who's going to take the loss. All the people the parcel is getting bigger and bigger as it comes towards you. But at the end of it all, when you get it and it's a small cap and there's some bad news, then you're going to be left with a loss, a huge loss. So again, buyers beware. Please do your research properly and try not to follow khabaris.